China's economy has long been one of the world's most closely watched, and 2024 proved to be no exception. Official reports showed that the country achieved its annual growth target, a 5% expansion in gross domestic product, GDP, even as it navigated a host of domestic and external challenges. But as you can see from the graph, China's annual GDP growth, even though it achieved its annual growth target, is actually one of the lowest full-year GDP growth when compared to historical data. This is largely because of the recent economic slowdown that China has faced over the past few years since the start of the 2020 COVID-19 pandemic. But there's always more to a country's economic story than just their GDP. So let's talk about all the economic indicators that show how China's economy performed in 2024. Let's first start with the GDP, and not just the annual GDP, but the quarterly GDP, as it will help paint the entire economic story of China. Here's the graph for that matter, data from the National Bureau of Statistics of China. Here you can see that China's quarterly GDP growth rate has been around 5%. The fastest one was seen in the last quarter of 2024, which saw a quarterly growth rate of 5.4%. Let's now talk about what were the key drivers for this growth in China. One of the most important factors to understand China's economy is industrial output. Industrial production recorded a consistent growth rate in 2024. As you can see in the graph, the first months of and the last month of the year saw strong growth, in line with the overall GDP growth. This robust performance was driven largely by a rebound in production as firms ramped up activities to take advantage of supportive policies and to meet export orders ahead of potential tariff increases. This is also a stronger and better growth rate when we compare it to the previous year of 2023, which also saw slower GDP growth rate overall. Secondly, there's also retail sales and consumption. This is important for China's overall economy because domestic demand hasn't really been a driver of growth in history. It was only in recent years that China is transitioning from an export-led economy to a consumption-driven one. However, the retail sales growth rate in China hasn't really increased as fast as industrial output. As you can see in the graph, it was only in the early months of 2024, such as February, that saw more than 5% in growth. The rest of the year saw lower, as low as 2%. The reason being is because China has faced a series of economic challenges that have dampened consumer spending. Problems ranged from economic uncertainty to continued property market downturn and even global trade tensions. But we'll talk more about those later on. For now, let's continue and talk about investments made in 2024. There's an indicator for understanding China's fixed asset investments made into infrastructure, manufacturing, real estate, and similar other categories. Here's a graph with data from the National Bureau of Statistics of China on China's fixed asset investments. Here you can see that China's fixed asset investments saw stronger performance in the first few months of 2024, but in later months, especially in the last month, it saw lower growth rate. For the entire year, China's fixed asset investment saw a growth rate of only 3.2%, which was an investment totaling 51 trillion yuan, or approximately $7.15 trillion. A big reason for this slower economic growth rate is because of China's property sector. From January to November, China's fixed asset investments saw a growth rate of 3.3%. But it would actually be so much higher at 7.4% if the property sector was not included. Investments in property development during this period actually contracted by 10.4%, which is a major reason for this overall investments in China to look slower as compared to other metrics. Here's a graph to show you the fixed asset investment by indicator. Here, you can see that some sectors saw extraordinary growth. Purchase of equipment and instruments, for instance, saw 15.7%. There were other sectors, not limited to property development, that also saw a decline. One example is culture, sports, and entertainment, which saw a decline of 9.4%. Now, beyond the sectoral contributions, let's talk about the role of stimulus measures that was implemented in 2024. As many of you may know, 2024, along with previous years, saw a slower economic growth rate in China. Not a lot of people want to see this, which is why the government has implemented various stimulus measures to help increase economic growth rate. One big role where we saw the government stimulated the economy was in monetary easing. The People's Bank of China, PBOC, shifted from a prudent monetary policy stance to an appropriately loose one, cutting benchmark interest rates and reducing the reserve requirement ratio, RRR, for banks by 50 basis points. This move was intended to increase liquidity and lower borrowing costs, particularly for sectors like property and manufacturing. Let's graph out China's loan prime rate. Here you can see that the loan prime rate of China has steadily declined over the years. The reason for this is what we just mentioned. They were trying to stimulate the economy. But then again, it wouldn't really make sense, right? How can a loan prime rate stimulate an economy? Well, it is through the mechanism of reducing borrowing costs, which encourages businesses and consumers to take on more loans for investment and spending. When the loan prime rate is lowered, commercial banks can offer cheaper loans to businesses and individuals. This theoretically leads to increased capital investment, expansion of business operations, and higher consumer spending, all of which can boost economic activity. Beyond monetary policy, there's also fiscal policy. Fiscal policy is usually done by the government through changes in government spending and taxation. In China, fiscal policy is primarily managed by the Ministry of Finance, which uses tools like public investment, tax cuts, and subsidies to influence economic activity. For 2024, they have launched a series of fiscal measures, including the issuance of special treasury bonds. Then there's also the fact that the Chinese government had implemented measures to encourage spending. This was particularly seen in times when consumer sentiment was low. These ranged from surprise wage increases for millions of government workers to enhanced trade-in programs for consumer goods such as home appliances. Now, let's finally talk about the last piece of China's economy before we talk about the challenges. The last one we want to talk about is China's exports. Here's a graph on China's export growth rate year over year. Here you can see that even though we have seen several news reports out there about the decoupling of Western economies from China or people boycotting from buying Chinese products, the overall exports of China have actually continued to go up. As you can see from the graph, overall exports have either been in the high single-digit growth or more than 10% overall. In the last month of 2024, exports even grew by over 10.7%. For the entire year, China saw exports of over 25.4 trillion yuan and imports of 18.3 trillion yuan. In US dollars, these amounts to approximately $3.58 trillion in exports and $2.59 trillion in imports. Let's now talk about the challenges that China faced in 2024. One of them is, as we mentioned earlier, which is the property sector. The property sector had continued to see declines in 2024, even though the problems started way back in 2021 when Evergrande Group had defaulted. Here's a graph on China's newly built house prices, year-over-year change. Here you can see that in the entire year of 2024, there was not a single month where newly built house prices had gone up. Here's another graph, but on the property investments. Like newly built house prices, property investments have also continued to decline, with most months averaging a decline of more than 10%. This is, of course, weighing down not only on fixed assets investments, but also on consumer spending. As property prices decline, homeowners see their wealth diminish, leading to reduced consumer spending. This has a ripple effect on domestic demand and overall economic confidence. This is also one of the reasons why, even though there are consumer subsidies and wage increases made by the government to directly help stimulate the economy in 2024, overall retail sales were still slow, and that is because of this decline in the property sector. Another issue with China is that there are deflation problems. Here's a graph on China's inflation rate, year-on-year change. Here you can see that the inflation rate is really low in China right now, with months back in 2023 showing negative growth rates in inflation. This is what China is trying to fix, because if inflation were to be this low, then it signals weak demand within the economy, which can have serious long-term consequences. Finally, one last problem is the fact that some groups have claimed that China's economic performance may not really reflect the true economic story of China. While official statistics claim a 5% growth rate, some analysts argue that these figures may be inflated. Independent research groups like the Rhodium Group have estimated that actual GDP growth might be lower, sometimes suggesting numbers in the range of 2.4% to 2.8%, though these figures are hotly debated. Although some observers are skeptical, others note that various independent data points, such as trade figures, industrial production, and satellite imagery, tend to broadly support the official narrative, even if the exact numbers remain contentious. So as you can see, China is indeed growing, but there are still challenges that remain. But anyway, do let us know what you think. Thanks for watching.